Everyone knows Warren Buffett. He's one of the most successful investors of all time, with a fortune of over 100 billion US dollars. He bought his first stock when he was 11, became the CEO of Berkshire Hathaway at 35, and continues to hold the role till today. The big question here is, how did he do it? What's his strategy? Hi everyone, I'm Petar Petrov, senior analyst at TradingKey. In this video, we'll break down the 5 timeless principles behind Buffett's wealth and explore how retail investors like you and I can apply these strategies to your everyday investing. Before we start, remember to tap the like button. And without further ado, let's dive into the details. The first principle is value investing. It's all about finding companies whose stock prices are lower than the intrinsic value. When he first started investing, he followed his mentor Benjamin Graham's cigarette butt strategy of finding distressed companies with just a little value left. After partnering with Charlie Munger, Buffett has since refined his approach to focus not just on undervalued companies, but on great businesses at a reasonable price. As Buffett once said,
"The price is what you pay, value is what you get."
The second principle is prioritizing long-term outlook. As a value investor, Buffett believes in holding assets for the long term, as it takes time for the market to value it correctly. He famously avoids checking stock prices daily because to him, short-term market fluctuations are irrelevant in the bigger picture. This contrarian mindset allows him to sidestep the dot-com bubble back in the early 2000s and go all in during the 2008 financial crisis. Buffett shares,
If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
The third principle is investing in business moats. As a long-term investor, Buffett favors companies with a proven track record of long-term development potential. This includes brand power, pricing control, and cost leadership. Think of Coca-Cola global dominance or Apple customer loyalty. These qualities can help companies resist competitive pressure, thereby protecting profitability over time. He says,
It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
The fourth principle is investing in the company, not the stock. Buffett doesn't just buy stocks, he views it as an acquisition of the business. Therefore, he goes to great lengths to fully understand what the business does, its operations, and its products. This is also one of the reasons why he famously avoids speculative assets like crypto. More importantly, Buffett attaches great importance to the quality of management, as highly capable management drives long-term success. He shares,
I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later one will.
The fifth and final principle is understand risk. While traditional finance defines risk as a volatility, Buffett sees it in a very different way. To him, risk isn't about how often a stock moves, it's about whether you could permanently lose money. Buffett believes real risk comes down to 3 things: whether you can confidently assess the company's intrinsic value, whether you're willing to hold it for long term, and whether the business itself is fundamentally sound and predictable. He often refers to the market as Mr. Market, a multi-business partner who shows up every day with a different price. Some days he's euphoric and the price goes up. Other days he's depressed and the prices go down. One of his saying goes,
When Mr. Market is furious, that's often the best time to buy high-quality assets.
Now that we understand the key metrics Buffett uses to evaluate the company, the next question is, how does this play out in real life? Let's take a closer look at his actual portfolio, starting with Apple. Even though Buffett has traditionally stayed away from fast-changing sectors like tech, he made a rare exception here. He began building a position in Apple back in 2016, and today it stands as Berkshire Hathaway's largest holding. Well, why would he break his own rule? Firstly, Apple has an increasingly strong balance sheet, a massive cash reserve, and an unparalleled ability to generate free cash flow. Secondly, Buffett saw Apple not just as a tech company, but as a consumer brand with deep loyalty and a durable moat. Even with premium pricing, Apple's ecosystem keeps customers coming back for more and more. Similarly, Buffett has a liking towards Coca-Cola. He started buying shares in 1988, shortly after the crash, seeing it as a long-term opportunity amid the market fear. Today, Berkshire owns nearly 9% of the company, reaping close to $1 billion annual dividends. What truly drew him was Coca-Cola's global dominance, massive brand portfolio, and their impenetrable market position. It checks all his boxes of constant earnings, brand strengths, pricing power. And yes, Buffett himself drinks several cans a day. In addition, Buffett financial holdings are also worth noting. Bank of America and American Express represent 2 of his largest bets in the sector. He has spent decades in insurance and financial services, fully understanding how this business operates. At the 2025 Berkshire Hathaway shareholder meeting, Buffett addressed the elephant in the room, AI. While he acknowledged its importance, he has made it clear that he's staying on the sidelines for now. This aligns with his principles, as he's not one to invest in companies just because they're trending. Without a clear proven business model or long-term moat, he's content to wait, even if that means missing out of names like Nvidia. His patience is reflected in Berkshire Hathaway's record cash position of $350 billion as of Q1 2025. Recent filings review new positions in Constellation Brands and Domino's Pizza, signaling quiet confidence in the consumer and food sectors. Buffett's success doesn't come from chasing trends. It comes from sticking to what he knows and wait for the right pitch. Whether it's Apple, Coca-Cola, or American Express, his investments reflect deep conviction and not just speculation. For everyday investors, there's plenty to take away. Stay in your circle of competence, prioritize durable businesses, be patient, and when the opportunity strikes, act with confidence. If you would like to track Buffett's moves in real time, check out our Star Investors tool at TradingKey.com. Get access to detailed sector allocation and 13F filings from over 100 top investors all in one place. If you found this breakdown helpful, be sure to like the video, subscribe, and drop your thoughts in the comments. We would love to hear what you think about Buffett's strategy. Stay informed, stay strategic, and we'll see you in the next one.